It's all about what's in the price, isn't it? I mean, we know that this economic data is going to be pretty dire, and that's because lockdown has been quite sudden, it's been quite dramatic, and we've seen a sell-off from the market to kind of compensate for that. You mean, to give you a statistic, in the financial crisis, it took 200 days for us to reach a bear market. It just took 20 during coronavirus. So the market's discounted quite a lot of this bad news. What's really worrying markets at the moment, or the focus of markets at the moment, is how long will we be in lockdown, and how much easing of economic activity will we see beginning over the next few weeks. So if we do start to see the economies coming back to full strength, let's say in 1-2 months' time, then I think the economic data we're seeing at the moment is more of a curiosity than necessarily something that's driving market sentiment at the moment.
Now, one sort of trend that stuck out to me amid the rally is the difference between European and U.S. markets, with the Euro stocks bounce really lagging what we've seen in the U.S. And I know there are a few factors that could be at play here. The fact that the U.S. has the tech giants, which have been key beneficiaries of the trade we've seen. But I'm curious, in your view, what needs to happen for Europe to catch up, and do you see that gap closing?
I think there are two factors at play here. One, we've seen outsized stimulus from the United States, both in terms of fiscal and monetary. In the Eurozone, we've seen monetary stimulus, but we haven't seen that joined up fiscal stimulus. And this is clearly something that's bubbling away in the background with the EU Recovery Fund, but we haven't seen anything yet. The other factor, as you alluded to, is that value versus growth bias. So in Europe, we're still far more of a value market, so banking, resources being major incumbents, whereas in the US, we have more of a technology focus. And I think the key point is, with rates even lower now than they were at the start of the year or a year ago, that is actually a positive backdrop for growth stocks. It allows markets to be very patient. It allows markets to be patient for economic and corporate data to improve, but also for earnings growth to come through. So if you're an exciting upstart company and in 5 years' time your earnings are looking fantastic, markets now looking through that as a discounting mechanism, saying, actually, we don't really need to pay much to actually wait for those numbers to come through. And that's why growth is doing so well. So the US is having that double hit from both fiscal stimulus, but also from a strong growth sector in its economy.